Today, an important update on mortgage stress. Hello again, it's Martin North from Digital Finance Analysts. Welcome to this post covering finance and property news. Well, of course, the RBA on Tuesday lifted interest rates to the latest high of 4.35%, and there are expectations that in fact they may go even higher. These higher interest rates are having a very profound impact on households. But today what I want to do is to look at our latest data relating specifically to the pressure on households in the context of some of the broader information that's out there. And I'll also share the latest from our surveys. Next week I'll go into even more detail on the live show and you can ask a question directly at that point. But let's start by looking at a very important data point, and that relates to the way that the inflation weights are calculated. Because according to the ABS, around a quarter of the CPI is actually driven directly by housing. Now that of course is relating to the cost of rent and also the costs of new construction, because mortgage payments are themselves not actually contained within the CPI calculations. There's a debate about whether that's correct or not, but that's the way they do it. But this is a very important observation because it means that if house prices continue to rise and if rents continue to rise, that's going to put more upward pressure on inflation, which in turn means that the RBA are likely to lift rates even higher. And we know already that the household debt servicing costs have gone through the roof. This data, which is from CBA and using data from other sources too, is a bit of an illusion insofar that, of course, it divides the total number of households, not just those who are paying a mortgage, which means that the record high of more than 10% going to debt servicing costs understates significantly the true reality. In fact, if you really wanted to make a better estimate, you'd need to multiply it by 3, because about 1/3 of households actually have a mortgage. Now, just another contextual point here, and that relates to the failure of building firms. If you argue that one of the key reasons why inflation is high is because the cost of housing is so high, and we know that the supply of buildings to live in is not catching up with where migration is, then the question is, what's happening to the residential building sector? Well, the answer is, according to ASIC, there are a larger number of business failures. That 783 home building firms collapsed over the September quarter. That compares to 605 over the same quarter last year and 238 in September 2021. And the latest data, as contained in the Financial Stability Report from the RBA, shows that the number of large builders with negative cash flow has gone up, and the share of trade credit builders owing suppliers more than 91 days has also risen. So we also therefore can conclude from this that the whole supply side of property is considerably messed up. Now this takes us more directly then to the question of mortgage stress. And of course, there are many definitions of mortgage stress around the place, and many of them are based on a specific set of assumptions about the way to assess mortgage stress. So one of them that comes up quite often is from Roy Morgan. Roy Morgan uses a sort of proxy for mortgage origination from the banks when they make their assessments, but they are suggesting that there are around 1.6 million households that will fall into mortgage stress if the RBA lifted once and then twice. This was actually published before the decision on Tuesday. And they've come up with a number of about 1.5 to 1.6 million households with a mortgage in difficulty. And they do highlight that there's a range there of difficulty that households are in. So the Roy Morgan approach is to mirror quite closely the way that the bank's underwriting standards work. More recently, Ben Phillips from the ANU published a different approach. Now, this is based on the percentage of households paying 30% of more than their household income on mortgage payments. And they also specifically call out the percentage of low-income households, the bottom 40% of households by income, paying more than 30%. And their conclusion is that there are a considerable number, and it's rising, 48.5% in 2023. And of course, as rates go higher, that's going to go up. So I have to tell you that this idea of using the 30% of income, it's still very much quoted in the media quite often, is really not very helpful insofar that different types of households have very significantly different weightings in terms of their ability to service their mortgages at 30%. Some more affluent people can do that quite readily, others less so. So, to my mind, this 30% conversation is not that helpful, which sort of takes us more directly then to the question of how to think about this. But just before we do that, let me just make one other point, which is a really important one. This other slide from Tarek, which in fact he and I discussed the other week, is a really important one. Because in the context of what's going on, the ability to service a mortgage is very much driven by how employed people are. And he makes the point that if the Australian labour supply continues to grow at the current pace and jobs growth reverts to its 5-year pre-pandemic average of around 22,000 per month, then the official unemployment rate would increase to about 5.2% by the end of 2024. Or in other words, there are going to be more households who are going to be experiencing pressure on their mortgage repayments because unemployment is going to rise. Now, all of those factors are things that we try and take account of in our modelling and our survey work, because trying to measure mortgage stress in the first place is actually quite a complicated business. I don't believe that you can use the simple 30% rule. I'm not sure that the approach from an underwriting point of view gives you the right answer. And by the way, if you just merely measure defaults, that's significantly downstream from mortgage stress, because people can muddle through for quite some period of time and still maintain their mortgage repayments under duress, which takes us quite nicely to the DFA approach. Now, we use a core market model that we've developed over the last 20 odd years, and into that we take data from our 52,000 rolling households and model it against various other factors to be able to come up with some sensitivities around the way that households are behaving. So ours is very much a focus on household finances and cash flow rather than external measures, as discussed earlier. And we can also slice and dice the data down to a postcode level, and also looking at our different segments, because different types of households have very different behaviours, as we've shown over the years. We can take our core market model and also then think about where scenarios might be playing out ahead. And those scenarios are not forecasts, but they are indications of what might happen depending on how the financial situation of households and more broadly in the economy run. And the core market model therefore allows us to look at mortgage stress, the price trajectory in the history, the buying and selling intentions, the migration. And I've done a lot of work recently on trying to factor in the higher levels of migration. More than 500,000 people have come into Australia over the last year, and that's flowing through now into the data, into the model. And that has changed some of the dynamics that we'll discuss later. We can also look at the broader economic CPI, wages and employment data as well, put all of that into the core market model and calculate at a postcode level as well as rolling up, and then come up with some scenarios about what may happen. And by the way, if you want to have a very detailed conversation about a particular suburb, we do still run our one-to-one service. It's not a financial advice session, but we can share trends and information about the way that we see our data running. And we can look at stress home price data and also look at perhaps where price trends may be heading based on our modelling. And you can have a conversation up to an hour, perhaps via Zoom or via phone. And there is a cost involved simply because there's a lot of research to be done to be able to have the conversation. So if you are interested, then feel free to go across to the DFA blog. And we're booking 3 to 5 weeks ahead because of the amount of research that's required and the demand we've got for trying to make sense of what's going on at the moment. Anyway, now let me come back to the definition of stress on the DFA focus. So we don't think that the 30% of income or taxable income or underwriting metrics adequately defines mortgage stress. We look at it in cash flow terms. That also, by the way, allows us to look not just at mortgage stress, but also rental stress as well, which is a very important other dimension that we'll touch on shortly. Now, what we do is to say if households have more outgoings, that's excluding one-off discretionary items, than income, then we define them as stressed. If they have a mortgage, they're in mortgage stress. If renting, then they're in rental stress. Investors with cash flow pressures are identified as stressed investors, and we can also aggregate the data to measure total financial stress. So that's all types of households, whether they have a mortgage or whether they're paying rent or whether they're an investor. And we can express this information as a percentage of households and counts. The latter, I think, is a better way to express the data because it's really about the big numbers rather than the percentages. So let's look at the mortgage stress outcomes for October 2023. And we start by looking at the rental stress aspect of this. And unfortunately, rental stress has risen again. So at the end of October, 72.97% of households with a rent are having cash flow issues, and that's never been higher. As you can see there, it's gone through the roof. Mortgage stress, in other words, households with a mortgage, are also significantly higher at 50.2% of households. Compare that with 32.9% back in February 2020, and you can see that there's been a considerable rise. No surprise given the high interest rate movements, and given the fact that more people are still coming off fixed rates to higher rates, you've got to expect the mortgage stress will continue to rise ahead. And by the way, just for completeness, the household debt ratio from the RBA is sitting at 186.7. They do mess around with this number, so it's not very helpful. And it also, of course, is against all households rather than those with a mortgage. So you need to multiply by 3 to get a true assessment of what's really going on. Now, here is the latest data relating to the mortgage stress analysis and rental stress analysis and investor stress and financial stress. And just quickly, you can see that mortgage stress at 50.15% translates to 1.93 million households with cash flow pressures on their mortgage. The rental stress number at 72.97% is more than 2.25 million households paying rents with a cash flow problem. We've got 22% of investors struggling with cash flow on their investment property. That's 647,000 households roughly. And the overall aggregate for financial stress is 49.64%, which is more than 4.8 million households. So just under half of all households across the board are actually having financial flow pressures. What we've then done is to highlight across the states in yellow where the numbers have gone up from last month. So New South Wales, Queensland and Victoria all reported higher levels of mortgage stress in the month. There were slight adjustments down in the ACT, in the Northern Territories, in Tasmania and in Western Australia. Rental stress, unfortunately, was higher across the board. And you can see there that the ACT and New South Wales were leading the charge, 79 and 78%. Victoria was 74% of households. Property investors were also stressed more in New South Wales. They were a little easier in Victoria. A problem also in Tasmania as well. And overall financial stress, that accelerated everywhere other than a slight fall in Western Australia. So unfortunately, this is the continuing story, and with the higher interest rates and the higher rental costs, we've got to expect this to continue. If we then look at it by segment, and I should highlight here that the yellow here is not comparing it to last month, but just calling out where the big numbers are. So if you look carefully, young growing families, including a lot of first-time buyers at 89%, have the highest levels of mortgage stress. But we also have large numbers of people on the battling urban fringe and on the disadvantaged areas as well around the major cities. We call those the disadvantaged fringe. They have very high proportions of people with mortgage stress. And those are little high growth corridors, as we'll show shortly. If we look at rental stress, we can see there that the multicultural establishment, the first generation migrants, have the highest levels of mortgage stress with 84% in difficulty. Young affluents and young growing families are also up there as well. If we look at investors, not surprisingly, those with a greater portfolio of investment properties have more difficulty. So exclusive professionals, the most affluent households, and young affluents have the highest proportion of problems on their investment properties now. And that's because whilst they can put the rents up to an extent, there's a limit. And with high interest rates now coming through on those mortgages, particularly with multiple properties, more people are now getting into difficulty and in some cases are choosing to sell. And overall financial stress was highest amongst young growing families at 71%, and for those in the urban fringe, the battling urban in particular, at 61%. We can briefly then just look at the largest counts of households in mortgage stress, and those following these trends over recent months will see that there's been little change, but the numbers have gone up a bit further. So the postcode with the highest count of households in mortgage stress across the country is postcode 2170. That's around Liverpool. And then we go to West Australian postcode 6065, which includes places like Tapping. And then we come back to Campbelltown in New South Wales 2560 with more than 12,299 households in difficulty. And then we go to Toowoomba, postcode 4350 with just under 12,000. And then Victorian postcode Roxburgh Park, which includes Donnybrook and Craigieburn, postcode 3064. Back to New South Wales to Camden and the areas around there, postcode 2570. Then Victorian postcode 3029, including Hoppers Crossing, and another high growth corridor 3805, including Narrow Warren and Fountain Gate. Then Cranbourne in Victoria 3977, and Pakenham 3810. All of those are high growth corridors, along with Berwick and Harkaway, postcode 3806, and also Point Cook, Derrimut and Werribee. Then we go to regional areas like Ballarat, postcode 3350, and back to New South Wales into places like Riverstone and Marsden Park, 2765. If we flip over to rental stress, centre of Melbourne, postcode 3000, has the highest count of rental stress with more than 15,000. Then we go to Toowoomba with more than 13,900. Then to Liverpool with more than 12,600, postcode 2170. Then Hoppers Crossing, 3029. And then Labrador and Southport in Queensland at 4215. Then Westmead and Wentworthville in postcode 2145, New South Wales. And then Campbelltown, 2560. Then up to Queensland in places like Coomera. Back to New South Wales, Waterloo and Zetland. And then postcode 2770, including Lethbridge Park and Mount Druitt. Then back to Victorian postcode 3030, Derrimut, Point Cook and Werribee. And then another Victorian postcode, Craigieburn, Donnybrook, Roxburgh Park, 3064. And then back to Blacktown in New South Wales, 3148. Yatala in Queensland, 4207. And then around Ipswich, 4305. Gosford, up on the mid-north coast, 2250, and then Cranbourne in Victoria, 3977. So once again, the high growth corridors are very much there as well. If we then look at stressed investors, well, not surprisingly, if there are lots of renters in difficulty, then investors also, so more than 4,800 in the centre of Melbourne. And then we go to Westmead and Wentworthville, 2145 in New South Wales. Then we go to Tasmanian postcode 7250 around Launceston, where we have quite a few investors who are now struggling. Then we go back to postcode 2146 in New South Wales, Tongabbie, and then Bundaberg 4670, Lane Cove and places around Northwood and Riverview, postcode 2066. Then postcode 4215, Labrador, and Southport. Then to Cranbourne, 3977. Strathfield, 2135 in New South Wales. And then Newstead and Fortitude Valley, 4006. Back to Pagewood and Maruba, 2035. And then Surrey Hills and Darninghurst, 2010. And then Coomera and Upper Coomera in Queensland. And then St Kilda in Victoria, 3182. And then Surfers Paradise, 4217. And Highgate Hill and South Brisbane, 4101. And finally, if we look at the overall aggregated financial stress, so that's all types of households, the postcode with the highest financial stress count this month is Toowoomba, with more than 28,200 households in postcode 4350. Then Liverpool, postcode 2170. Campbelltown, 2560. Tarnit and Hoppers Crossing, 3029. Roxburgh Park, 3064. Cranbourne, 3977. Centre of Melbourne, postcode 3000. Then Derrimut, Point Cook, 3030. Back to New South Wales around Mount Druitt and Lethbridge Park. And then out to regional areas like Ballarat, 3350. Up to Queensland, postcode 4215, including Labrador and Southport. Then back to Westmead, Greystanes and Wentworthville, postcode 2145. Back to Western Australian postcode at Tapping, 6065. And then Bundaberg, 4670. And Ipswich, 4305. Springfield in Queensland, 4300. And then Coomera in Queensland too. So you can see here that there is considerable pressure now across the country. It's not just in Sydney and Melbourne. And again, it's the high growth corridors where a lot of the pressure lies. Now here's one other piece of analysis which I'm going to now do regularly, and that is the risk of default. So this is looking ahead over the next 12 months. And what we've done is to estimate the proportion of mortgage borrowers who risk default, and also the number. Now the numbers are better indicated than the probability of default, and of course you may dip into default and then dip out again over the year. Nevertheless, the postcode with the highest risk of default, more than 1,200 households over the next 12 months, is Cranbourne, postcode 3977. And then we go to Western Australian postcode 6210, including Mandurah, places like that. Then we go to Hoppers Crossing in Victoria, 3029. And then we go to Armidale and Brookdale in Western Australia. Back to Victorian postcode 3064, Roxburgh Park. And then Western Australian postcode Success. Queensland postcode 4207, including Gatella. And then Gosford and areas around that on the mid-north coast. Bundaberg in Queensland, 4670. Tapping in Western Australia. Toowoomba in Queensland. Point Cook and Derrimut in Victorian postcode 3030. And then Pacific Pines in Queensland, 4211. And Coomera, 4209. And Mackay, 4740. Now the point to make here is that there are a lot of high growth corridor areas where there's been a lot of recent purchases, a lot of households who bought 2 or 3 years ago when interest rates were really, really low. Quite a few of them are now having to work more jobs to try and get by. They're cutting back on expenses. But with interest rates continuing to rise and with some of those fixed rates rolling off, we think that more households are going to get difficulty. And of course, the cost of living are rising much faster than real wages growth. And not everybody can work ever more hours or more jobs. So the cumulative effect over the medium term is that more people are going to get into difficulty. Now, it's worth saying, of course, that many people with financial pressure on their mortgages will be talking to their lenders, and the lenders are quite willing to extend the term of the loan or maybe even go interest only for a period of time. That benefits the banks, of course, because it means that they're not then having to recognize that as a distressed household. Therefore, they can keep the default numbers down. But of course, the question is whether it's actually the right thing for households. Sometimes it's not a good thing to just keep paying and trying to keep the interest rate going. Because eventually, if interest rates stay high and the cash flow pressures continue to rise, people will have to take more vigorous action. Let me just now finish off with a quick update on our scenarios. Now, as I've said before, scenarios are a way of exploring different futures and to consider the consequences. It's not a forecast. It's helping to have a debate about where things may go. None of these scenarios may turn out to be right because things change. And we do use that framework driven by a core market model. And we look at 3 potential outcomes updated with the latest data and the results. And the scenarios effectively run forward from today. Here are the 3 scenarios. The first scenario is the Goldilocks zone. Now, of course, with rates at 4.35%, you've got to hope that rates won't go any higher and they'll fall next year. Inflation eases ahead of expectations. That's not happening at the moment, of course, and wages will rise faster. There's no recession, and we also have to assume that migration remains well above the long-term averages. So we're talking, 300, 400, 500,000 more people coming into Australia. So that would give some support to home prices. The base case is a soft landing where rates continue to rise, maybe 4.6% plus or minus, which means that you see mortgage rates at 6.95 or more, and they will stay high over 2023 into 2024. Inflation stays sticky above target until 2025, but there's no recession in Australia, and migration does begin to fall to around average levels, 200,000 plus or minus. The nightmare scenario is that rates rise above 4.6%, which will give you a mortgage rate of 7.5 to 8%, and they stay high along with inflation. And wages growth then starts to stall due to recessionary forces really biting. They do cut interest rates later, but of course it's too little too late. And in the meantime, migration drops below the long-term average. So those are the 3 scenarios we look at. And if we then translate that into what may happen, here's the overall scenario across the country. And first we look at the best scenario for houses. So in fact, we've got an expectation cumulatively that there will be, in the best case scenario, a further rise in home prices over the next 2 or 3 years, with about a 9% rise over the next 3 years cumulative. On the other hand, if our base case scenario plays through, then there's going to be a bit of a fall in prices, perhaps up to 10% over the next 3 years. And if we get into that really nightmarish scenario, there is still downside risk. Remember that prices are significantly above long-term trends, and so there's a risk to the downside. And looking at units, there's a relatively similar track with, again, unit prices potentially on the upside in the best case scenario, but there's also a slide in the base case and a more significant slide in the worst case, although not quite so bad as the house scenario. And just to look at it on a state basis, here's Queensland. So in the best case scenario, we could see 11% over the next 3 years for houses. In the best case scenario, although the base case would be a fall and the worst case would be also a fall, a more significant one. And again, units performing a little less well, but also risking a fall if we have the base case scenario playing out, and the worst case, not quite such a deep fall as houses, but still a fall. Now, if we look at Tasmania, there is a fall over the next 12 months, a small recovery over the 24 months, and a small rise over 36 months. Cumulative speaking, best case scenario, the base case is a fall, actually quite a considerable one, and the worst case would be a considerable fall, down 28% over 3 years. Units performing quite closely in the best case scenario, not quite so good, not dropping quite as much in the 2 negative scenarios, but still considerable falls. And I'll just look at one segment, so the young growing family segment. We don't think there's much potential growth amongst young growing families at the moment because of the fact that mortgage stress is so high. So even in the best case scenario, we think property prices will go sideways for that particular segment. There's also a risk that prices could fall, and the base case scenario is a 20% fall over 3 years. The worst case is a considerable fall back to long-term averages, as explained if the scenarios play out negatively. Units tracking pretty much the same, although not falling quite as much in the two negative scenarios. And finally, just to say that we have updated our core market model down to a postcode level. Here's an example for Wollongong, and this is the granularity of information that we can report. And next Tuesday I'll be walking through some of these postcodes, so if you've got a particular postcode you'd like me to look at, feel free to come on the show and we can look at it in detail. What we're trying to do here is to show the relative distribution of those borrowing, those owning outright and those renting, the relative levels of mortgage stress, the scenarios as I've shown you previously but at a postcode level, as well as information about the mix of properties in the particular postcode, the people ratios, in other words how many people per household in the house or unit, and also information about the gross and net investment yield on investment properties. But the most critical part of the story relates specifically to the question of the disposable monthly income, because this is where the rubber hits the road and why I think that our approach to measuring mortgage stress is more accurate than many other people's. Because what we do is we look at the disposable monthly income and then we say what proportion of that is going to pay the typical mortgage or the typical rent. And in this postcode, which is Wollongong, 43.8% of the disposable monthly income, or more than $2,467 a month, are going on those with a mortgage, and around 35% of those renting at $1,993 per month on average is going to those who are paying their rent, which is why the stress levels are so high, which is why we think that there is going to be some pressure on households in many areas. So the point to make here is that looking at this granularly is the only way to go, because of course averages mask, and I get quite frustrated with some of these high-level reports on property price movements or even high levels of stress that don't go into granularity. The fact is that not all households, not all locations, not all types of property are equally exposed. So I hope you found that useful. If you would like more information about the specifics of a postcode, come join the live show next Tuesday, and we'll be able to go through that in some significant detail. And I'll also share some further mapping, because we actually do maps of this data as well to show where the hotspots are. But the bottom line is there are more households getting into difficulty. I don't think the RBA is going to cut rates anytime soon, which means it's now on to households to try and get their budgets sorted out. And the quick steps are, of course, first make sure you've got a cash flow so you understand where your financial situation is. If you have got more money going out than coming in, you need to prioritize effectively to be able to work out how to deal with that. And if you have a problem with your mortgage, talk to your lender, but go in there with your eyes open, because what they'll be doing is looking after their own interests, not necessarily your own interests. But the bottom line is this: given the lack of supply of housing and the high migration, house prices will have some support ahead. Interest rates are going to stay higher for longer, and that's going to put more pressure on households. And we have a lot of households with large mortgages with nowhere to go and are now muddling through from month to month with little help available. We've got ourselves into a right royal pickle here, and unfortunately my feeling is that we're going to see more households in more difficulty. In other words, I don't think my mortgage stress analysis is going to ease back anytime soon. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.